I didn't realize it was even you were running for this.
Thanks everybody for joining us. Minister Chambers and Minister Donoghue are joined by John Canal, Assistant Secretary for Expenditure, and John Carr. We'll start John with a short presentation, then we'll move to the ministers and then we'll take questions.
Okay, thanks, Deb. Okay, so I'll provide a brief overview of the document. As everybody here is aware, what we're setting out today really are the macro fiscal parameters for Budget 2025 without identifying the individual policy instruments. So I can be very brief then on the economic backdrop, maybe too brief. Okay, just in terms of the external situation then, the graph on the left shows IMF forecasts for Ireland's major trading partners. In green is the sort of historical norm for both the US, UK and Euro area, and in gold then you see the forecasts for this year. Really it's a case of the US leading and the UK and Euro area lagging. So, I mean, that does raise some issues for the indigenous sector of the economy, etc., given the importance of the UK as an external market. The graph on the right-hand side then shows the 5-year forecast from the IMF for the global economy. I think the key takeaway here is that if you look beyond the short term, the growth rate for 2029 is the 5-year ahead forecast is the lowest it has ever been for the global economy. And that really reflects issues like demographics, trade frictions, deglobalization, those sort of issues that we have been identifying within the department. On the prices front then, somebody move on the next slide. Okay, thank you. The key point here is that the pace of disinflation in major trading partners has been really fast, I guess faster than would have been anticipated. So in all regions, inflation is now running at about 2%, having been in excess of 10% in some regions as recently as 2 years ago. And this really reflects the impact of monetary policy tightening. which really has been the most aggressive pace of tightening really in a generation. I kind of think about it as the kind of the 3 S's: the speed, the scale and the synchronization of monetary policy tightening. So what does that mean then for the domestic economy? Okay, the graph on the left shows inflation in Ireland, and I think the key takeaway here, we elaborate a little bit on this in the document itself, is that the first round effects from the energy price shock have now unwound. Inflation at the moment is running at 1.5%. About 2 years ago, it was running at 9.5%. And I think it's fair to say the evidence of second round effects, so kind of wage price spirals, etc., really has diminished at this stage. And if you look at the graph in blue, you can see that core inflation is now just 2.3%, its lowest level again in about 2 years. So essentially what that means is that real wages, real take-home pay, real incomes, etc., are now in positive territory for the first time since mid-2021. And this is supporting consumer spending and modified domestic demand, which is the graph on the right, where you can see it grew by 1.5% in the first quarter of the year. One really noticeable feature of the post-pandemic recovery really has been the labour market. Graph on the left shows employment growth in Ireland from just before the pandemic to now, and it compares it with every other euro area country, as well as the US and the UK. Total employment in Ireland is up by 340,000 over that period, an increase of 14%. Only Malta is stronger. I actually don't know what's going on in Malta, but Ireland really is an outlier there. Graph on the right then shows unemployment, and it shows unemployment relative to its historical norm. So the shaded area is the historical norm, so the min-max over 20 years leading up to the pandemic. The circle then is unemployment right now. And despite the most aggressive tightening of monetary policy, you can see that unemployment in practically every country is close to its lowest level ever. In Ireland, the latest figure is 4.3% for the first quarter of this year. Okay, moving then to the fiscal situation, just want to highlight the issues on corporate tax. You'll have heard us talk about this on many occasions. This is the share of total corporate tax that comes from the top 10 firms. A decade and a half ago, about 15% came from 10 companies. Last year, over half came from 10 companies. Maybe a better way of looking at it is the graph on the right, which shows that which shows the amount of total tax coming from 10 companies. So if you look at this in 2008, for instance, €1 in every 45 euros came from 10 companies. Last year, €1 in every 7 that the state took in came from 10 companies. So there is a big concentration risk that needs to be noted. Okay, coming to the end, just in terms of the budgetary strategy then that the two ministers are setting out today, the key objectives and trade-offs. The key objective really is to continue to address the infrastructural deficit, especially on the housing front, to provide more health spending with some conditionality, and that's set out in a box in the document. There's more health spending for both this year and for next year. To continue to support households and firms in a context of where consumer prices have risen by around a fifth over the past couple of years. And then to provide more public service in the context of a situation where the population has increased quite dramatically and where the number of people in employment has increased quite dramatically. The trade-offs need to obviously avoid overheating the economy, to reduce the reliance on corporate tax, etc., and that's why the Minister has established the Future Ireland Fund and the ICNF, but also to prepare as well then for the medium-term challenges, what we call the 4Ds. So then in terms of the overall package then, government is making available €8.3 billion by way of tax and spending for next year. Decisions already made. Government is providing for €5.1 billion to meet existing levels of service, as well as decisions already made. The breakdown of that is government is providing 1.5 billion for additional spending for health this year and 1.2 billion next year on an ELS, on an existing level of service basis. The public sector pay deal, the carryover effect of that costs 1.2 billion next year. There are several policy announcements that have a full year cost next year amounting to 1.3 billion, and NDP spending amounts to 1.4 billion. New measures then government is providing for new current spending amounting to 1.8 billion and an overall tax package of 1.4 billion. I'll skip the risks there in the interest of time and just conclude. I won't go through the numbers again, just to say that the numbers beyond 2025 are purely technical assumptions in the document. There will be a new government that covers the period 26 to 30, and they will set the fiscal parameters. We will update our economic and fiscal forecasts in the autumn as part of the budget, as we always do, and there's a new EU legal requirement to submit a medium-term fiscal plan in October. Thanks, Deb. I'll hand over to the Minister.
Thanks, Deb, and thanks, John, and good afternoon to you all. In a few moments, I'll outline the key points of the Summer Economic Statement, which sets out the fiscal parameters within Budget 25 and upon which it will be delivered. The last number of years have been defined by a series of successive major economic shocks. Indeed, perhaps the most important lesson of the past few years is that the world is becoming more shock-prone. Most recently in Ireland, along with almost all other advanced economies, we have grappled with the effects of multi-decade high rates of inflation and the related rapid rise in interest rates. Despite these headwinds, our businesses and our people have shown incredible resilience in the face of adversity, and the Irish economy has weathered these shocks remarkably well. Our commitment to supporting households and businesses through these shocks has been reflected in the scale of support we've provided to assist with the cost of living challenge. The budgetary measures we have taken over recent years have helped to ensure the underlying strength of our economic fundamentals, and this is most clearly evident in the labour market, with a record number of people in employment and an unemployment rate of just 4.2% in June. By any reasonable estimate, we are now at full employment. Therefore, at the current juncture, supply is the main constraint to growth. The cost of living pressures faced by households over recent years are undeniable. At its peak, inflation was increasing by close to 10% on an annual basis. Fortunately, we've made significant progress since then, and inflationary pressures have now dissipated, with inflation at just 1.5% in June, the lowest rate since April 2021. Against this backdrop, growth in the domestic economy is expected to gather momentum as the year progresses. Indeed, modified domestic demand is expected to grow by close to 2% this year, with a further pickup in growth next year. The Summer Economic Statement does highlight that risks remain on the horizon, with the most pressing risks external in origin. The potential escalation of conflicts around the world, geopolitical tensions and the further fragmentation of global trade all have the potential to have a disruptive impact on the Irish economy. At the headline level, our public finances are performing well.